Hey guys, what's good? I'm Andre and today I want to talk to you guys about a call on PLTR that I bought back in April that has now basically returned every single penny that I spent on it. It's not technically speaking a LEAPS because it wasn't initially dated to more than 12 months. I bought it in April and it's due to expire in November. It's a $22 strike price and initially it had a delta of 0.65. I paid $498 on it and so far I've been able to recuperate $357 through selling covered calls and collecting premium. This means that I'm now one single covered call away from being able to recuperate the full cost that this one long dated option had for me. And obviously, as you guys know, between April and now PLTR grew quite a bit and we are now at $27 roughly. It had a couple of rougher days, but it used to be even above $27. So I'm very positive here that first off, I'm gonna continue selling one call here and basically break even on that initial price that I paid for the LEAPS, but it's not a LEAPS, again, it's just a long dated call. And then I am very confident that come November PLTR will be at least $28 to $30. So I'm going to probably make quite a hefty return on the call option. It wasn't easy, but it was definitely fun and an experience worth having. PLTR didn't have the easiest year. I was expecting it to go a bit better here, and I'm not gonna roll this forward because I much rather would wait for PLTR to retrace back a bit and then buy a new one that's much longer dated than whatever I'd be able to roll this current one for. And then for this one, just take away the profits that I've been making so far, as well as the ones that will be still coming through the door by the expiry date. And then just again, as I was saying, as soon as PLTR proves that it has a good opportunity for me, either buy some additional stock or buy another LEAPS that's gonna expire sometime probably in 2023. So with this in mind, guys, I wanted to reference the idea of the poor man's covered call and how useful it actually is. This means that you basically don't have a full 100 shares of one stock, but do have the leverage of that one LEAPS option that you can use to sell covered calls. And this enables you to collect premium without actually having the large investment. So when I bought this option, actually, I believe that PLTR was somewhere at $25 if I recall. That would have cost me $2,500 to buy a full 100 shares of PLTR. Instead, I was able to buy the Delta 65 option here for $498, and obviously I've been able to sell covered calls, and despite the fact that PLTR hasn't been crushing it the way I was hoping it would, I still was able to collect quite a bit of premium. I mean, just imagine how much better it would have been if PLTR was indeed able to go to that $30–35 range where everybody was expecting it to trade for most of the year. So with this in mind, guys, again, the poor man's covered call is definitely something that helps grow small accounts quite a lot. Please only do it on stocks that are worth something and that are actually fundamentally good companies. Don't do it on your workhorses or Nikola's or Lordstrom Motors. So guys, that pretty much wraps it up here. If you have any questions, please leave them in the comment section below. If you have any specifics that you would like me to go into with regards to this one position, I'd be more than happy to share them with you guys. Leave a thumbs up and I'll see you next time. Take care. Have a fantastic day.